All right, guys, I want to unpack something that I hear often talking with clients, prospective clients, and anybody just kind of talking about taxes and real estate. So it's this thought that through depreciation, and specifically through like a cost segregation study, you can create these big losses that will offset or you'll be able to deduct against your W-2 or business income, et cetera, et cetera. So it's going to be probably a little bit longer of a video because what I'm trying to do is I'm trying to kind of dispel or some of the myths or educate people around real estate taxation, because people get their information in short clips, like a 30-second or 60-second video telling them to buy a short-term rental, telling them to buy a piece of property, do a cost segregation study, and they don't really know the nuance. And that's what's bad about social media. I'm not sure Facebook is the best medium for this, but I want to talk to people here locally, or people that, follow me wherever, just about how this all works. So let's get into it. We're going to give you, again, probably a little bit longer video. We're going to get into some of the basics around real estate taxation. We'll give you some terms, some definitions, and hopefully you leave this conversation with pausing when you hear information from other parties that are giving you a really short clip and something that might be too good to be true. So let's start with kind of some definitions of terms. So real estate in the tax code is what's called, it's inherently passive. Now, passive is not in the sense you're thinking of like doing more. It does have its roots in some of those definitions about how much work you do. But passive investments in the tax code are things that, if they produce a loss, are not deductible unless you have other passive income to net against. Okay? So let's just stop there. Real estate, by its nature in the tax code, is inherently passive. What that means is, by default, it's passive. You have to do things or have certain criteria to make it be not passive. So that's kind of water we're swimming in here. Real estate is passive. Let me contrast that to like your W-2 income or business or your S Corp or partnership income that flows through you from a business you work in daily. That's active income. Okay. So stop right there. If you have real estate losses, generally, this is not always, but most of the time, those losses cannot offset, because they're passive, cannot offset income from an active business or active income like your W-2. Okay. So at least just get those two things understood. All right. So why am I telling you this? Well, I'm telling you this because lots of times you hear somebody pitch to you like, buy a short-term rental, okay? Or buy a piece of property, a rental property, do a cost segregation study. We'll unpack that in a minute. And essentially what they're getting at is create a paper loss, so a tax loss via depreciation. And we could probably unpack what depreciation is, how that works, if you want to. But here's what I want to tell you. So you create that loss with depreciation, which is essentially you're taking a piece of the property and you get to write it off over time, but with cost segregation studies or with accelerated depreciation, you speed that up. Okay. So that's what people are talking about when they talk about a cost segregation or creating losses through real estate, is you're taking depreciation when coupled with the other expenses like the interest, the taxes, the maintenance, et cetera, are more than the income. Hence you create a loss. Now, what we do with that loss is really the crux of what I'm talking about, okay? So that loss generally is passive. Like I told you, by definition, inherently passive. Can't offset your W-2, business income, et cetera, et cetera. So if you leave this video with anything, just leave it with the skepticism you might get, or you should now get, when people say, you can buy a piece of property and that's kind of the magic bullet, so to speak, in the tax code to offset, kind of these loopholes only the rich know about, that kind of thing. Just not always true. Now, there are ways you can make real estate non-passive, which is the whole game, right? You want real estate to be non-passive because, again, subject to other rules like material participation, which we'll get into in a second. If you have real estate that's non-passive, well, then it opens up a lot more avenues for you to deduct it against your active trade or business income. And that's really the holy grail, right? We want the real estate losses to be able to deduct against our business or W-2 income or anything that's considered active. So how would you do that? Let's talk about the short-term rental loophole again. I told you this would probably be a longer video, longer than most that I do, but I really want to unpack this. The short-term rental gives you a little bit of a It's a loophole, man. It is what it is. And it kind of short circuits things because a short-term rental is by its nature not passive, right? Short-term rentals, the key there is you have to have the property rented on an average stay of 7 days or less, okay? So that's what would make a rental property a short-term rental, where the average stay, 7 days or less, okay? Here's the second caveat to, so again, everybody pitching short-term rentals, yes, they do make them non-passive, but there's a second part to it. You have to materially participate. Now, I'm not going to get into all the rules of material participation. It's like a 7-step test. But suffice to say, if you buy a short-term rental, do a cost segregation study, which we talked about again, to accelerate depreciation, create these big tax paper losses. If you do that and you don't materially participate, well, you're back in the same boat I told you about when you first started, which is, yeah, it's non-passive, but because you don't materially participate, it's effectively passive in that example. So, material participation. Essentially, you got to do more than other people on the property. There's other rules. Again, this video is not long enough to tell you all the rules, the caveats, grouping, elections, et cetera, on why a property could be, how you could materially participate. But again, if somebody's pitching you a short-term rental, you have to ask yourself, first, okay, it's non-passive if the average stay is 7 days or less. That's number one. If it doesn't meet that, there's other rules, but that's pretty much gonna put you off to the side in terms of it being short-term rental. But the second thing is, do you materially participate? Let me give you some kind of rules of thumb. If you have a manager, you probably don't materially participate. Why? Because they probably do more work on the property than you, and that's one of the criterias in determining how many hours you spend. Again, haven't talked about this, but hours and logs are your friend in the tax code in terms of mileage and deducting auto expenses or material participation. You have to prove how many hours. A contemporaneous log is really the standard. But if you have a manager, generally, they're going to work more than you, so you probably won't materially participate. So there you are again, where you can't deduct the losses. So if nothing else, I want you to leave this video thinking, man, if somebody's pitching to me real estate as a way to offset my trader business income, so if I'm a high income earner, a high income business owner, and I'm going, man, I'm getting crushed with taxes, and I want to take something and offset my income to reduce my tax bill, real estate could be the thing, but you've got to jump through some hoops. And I would tell you, the firms that do this really well, some of the firms that I follow, and even how we do it here at our Mire Group, the firms that I follow, they won't even take you on as a client if you don't have great records. Like the CPAs that just say, oh, we'll take your word for it that you materially participate, or we'll take your word for it that you meet the real estate professional exemption. Like, I would tell you as a taxpayer, beware of those people, because the people that I know that know the most about real estate are the ones that will require you to either have a time log or to make you go get one. So just be aware if somebody's pitching you this is the way to reduce my tax bill and it's through real estate, I would say that maybe it's hard and it's less than likely that it's going to work, but it can work. And if structured properly, you could easily defend it in audit. If you have a contemporaneous log showing how much you worked in it, showing your average stays being 7 days or less, you're on the right footing and you can do this. And I've pitched this to my clients. How to meet the real estate professional example. If you want to talk about that, drop it in the comments below. And I will talk about how that works. The real estate professional, that's another way to short circuit things. Effectively, that puts you on the same footing as a short-term rental in the sense that the property's not inherently passive at that point. So anyway, we'll talk about that, but just want you to leave this video understanding active versus passive, understanding material participation, understanding that it's not a magic bullet, and that if you're trying to do this and somebody's pitching this to you as the way to offset your trader business income, I would pause and at least just ask the question. So if you got a question about that, comment below, or a question for a future video or suggestion for a future video, I'll take that. Trying to do these more often. They help me, like anything, when you teach something, you'll ultimately learn more about it. So it's helpful for me. So I'll keep doing these. And anyway, we'll see you on the next one. All right, guys.